David Einhorn owns 42 stocks in his portfolio worth $2.2 billion. In this video, we're covering his top 10 biggest positions, starting with number 10, Viatris. Einhorn's one of 4 super investors who owns the company. He has 3.9% of his portfolio invested in the stock, and he increased this by 64% last quarter. Viatris's biggest super investor shareholder, none other than Bill Miller. Viatris is a $14 billion pharmaceutical company that trades $2 below its 52-week high. Viatris was formed through the merger of Upjohn and Mylan in 2020 to create the world's largest generic drug manufacturer. When we trace the company's history from the 1970s until the early 2010s, Upjohn was actually one of the world's top performing stocks. But since then, things have gone downhill. Today, the company trades 85% off of its all-time highs. Still, the numbers show there are things to like about the business. The company's cash flows have been relatively stable even with declining revenue since the merger. At the same time, they've also paid down a lot of debt. While it's hard to see given the large amount of shares they used for the merger, Viatris has actually repurchased stock in the last year. They still earn pretty subpar returns on capital, but these have been improving. Viatris also pays a big market-beating 4.24% dividend yield. When we couple this with their buybacks, they actually have a good 5.5% shareholder yield overall. Today, not only does Viatris trade below its historical sales values, it's also trading well below its projected free cash flows. Still, their guru focus value has trended downward since the company's merger, and today it's only at $10 per share. That's down 13% from their current stock price. Analysts are more bullish on the company, targeting a $15 price target with a 31.5% upside. David Einhorn is the founder and president of Greenlight Capital, a long-short, value-oriented hedge fund he started in 1996. Over the next decade, the fund returned 26% annually, easily beating the market. Einhorn receives extensive coverage in the financial press for his fund's performance, his investing strategy, and his stock positions. Einhorn was included in Time magazine's Time 100 list of the 100 most influential people in the world back in 2013. According to Investopedia, his net worth was around $1.5 billion as of June 2019. The next stock in Einhorn's portfolio at number 9 is Tenant Healthcare. Tenant is owned by 4 super investors today, and this is led by Einhorn, who has 3.9% of his portfolio invested in the company. Tenant operates hospitals, ambulatory surgical centers, and outpatient facilities across the American South. Tenant's a $15 billion healthcare company that's trading just $14 below its 52-week high and up more than 3 times from its 52-week lows. Their stock has been a wild ride for shareholders. They were one of the top performing stocks in the market from the early 1970s until the late 1990s. Then things went pretty downhill, and they're still trading 27% off their all-time high. Still, since the pandemic, their stock has shot through the roof, increasing by about 16 times. Some of this comes from what seems to be more stable sales and cash flow numbers in the last 5 years compared to earlier in the decade. As they operate a lot of healthcare real estate, Tenant does use a lot of debt in their business, which is something to be mindful of. And like the last 2 companies we've looked at, Tenant's been buying back shares in the past couple of years. Compared to their historical values, today Tenant's trading well below most of these, but they're well ahead of their median price to sales in their history. Part of that's why a GF value for the company only comes in at $84 per share, which is almost just half of their current stock price. Analysts are mainly bullish on the company, but say it's about fairly priced today with just a 4% upside and a $160 price target. The tech stock Aite is the number 8 stock in Einhorn's portfolio. He's one of 2 super investors who owns the business with a 4% holding. Aite is a $4 billion cloud-based HR provider that's trading $3 below its 52-week high. The company recently went public back in 2021, and since then it's down 23% overall. The main thing this stock has going for it is that it's growing and it's free cash flow positive, which is not the same as many companies listed at the same time. Still, not uncommon for these types of companies, they've diluted shareholders by a pretty steady amount in each of the years that they've been public. This is something to watch out for as their stock-based compensation remains high, although they'd still have free cash flow even if we back this out. Their GF value has trended slightly down since going public, and today it's just about their current stock price at $6.70 per share. Based on their cash flow numbers, it looks like the company could have a downside of about 5%, pretty close to that GF value. ODP Corp is next at number 7, and this is again owned by 2 super investors, with Einhorn having a 4.3% holding in the company. He added 30% in the last quarter alone. ODP is a billion-dollar distribution company serving small businesses. Today, they trade just $6 above their 52-week low, and they're down by half from their 52-week high. The company was a steady performer up until the global financial crisis, but things have suffered since then. Altogether, they're still down 93% from their all-time highs hit back in 2005. It seems like Einhorn would like this company for a couple of reasons. Even though they've had declining sales in the past decade, the company still has a decent cash position and manageable amounts of debt. They also consistently produce cash flows going back for about a decade. The big thing to love in this stock is they've been buying back shares like crazy, repurchasing 12% in both of the last 2 years and 8% in 2021. Altogether, they've repurchased stocks 6 years in a row. Based on the numbers, this stock could be cheap, as it's trading well below most of their historical valuations. That's what we see with their GF value, which today comes in at $51.50 per share. That's up $21 from their current stock price, nearly doubling it. Penn National Gaming, or Penn Entertainment, is the 6th stock in Einhorn's portfolio. He has a 4.8% holding in the company that he again added to in the last quarter, and he's the only super investor invested. Today, Penn Entertainment's a $3 billion company that trades just $4 above its 52-week low. Penn's a casino owner that had a steady track record before spiking just after the pandemic and come crashing back down to earth. They had huge earning losses and saw their operating cash flow cut in half, but the company still produces positive free cash flow. After using shares to buy other companies in their history, they actually bought back a lot of shares in 2022, and they repurchased some in 2023 as well. Penn looks potentially cheap if they can get back to their more normal free cash flows, but they have a lot of debt to support as well. A GF value comes in at $35 per share, which is nearly double today's stock price, but that does come with the value trap warning as well. Albeit analysts are split but altogether bullish on the company with a $24 price target and a 30% upside. Before we get to David Einhorn's top 5 stocks, if you're enjoying the video, check out my affiliate Interactive Brokers. Just by clicking the link below, you support the channel and you can check out their offerings. Stock number 5 in Einhorn's portfolio is KINDR, the IBM spinoff. He's one of 2 super investors with a position in the company, though he trimmed 33% of his holding in the last quarter. Today, it makes up 5.7% of his portfolio. KINDR has a $5.5 billion market cap and it trades just $4 below its 52-week high. The company's stock has performed poorly as a standalone business. They're down 40% from where they were listed, although they're up 200% from their all-time lows. It's hard to see many positives in their numbers, with the company having declining sales, negative earnings, and negative free cash flows. On top of this, they've also diluted shareholders in the last couple of years. Their GF value has trended down since being a standalone business, and today it comes in at just under $13 per share. That would cut their current stock price nearly by half. The 2 analysts covering the stock are bullish with a 37% upside and a $33 target price. HP is the 4th most owned stock by Einhorn, and he has a 5.8% holding in his portfolio. He's one of just 3 super investors in the company and nearly doubled his stake in the last quarter alone. HP is a $34.5 billion giant that's trading just $2 below its 52-week high. As one of the founding companies in Silicon Valley, it had an all-time great run from the 70s until the late 1990s. Since then, its stock price has been cyclical, and in the last handful of years, it's traded around the same range. The numbers behind HP look like they've more or less flatlined in the past decade. They still earn decent returns on capital, and they generate good amounts of free cash flow. But things have trended down overall, and they've added on some debt in recent years. HP has actually reduced their share count from 2 billion shares outstanding in 2012 down to just under 990 million shares in 2023. For much of this period, they were repurchasing a ton of shares in their stock. That's why Warren Buffett even owned the company in 2021. But 2024 has been very different for the stock, with them actually issuing shares and diluting shareholders. That's been the complete opposite of the past decade for the business. High share buybacks were even more attractive for HP shareholders because they also paid a big 3% dividend yield, and they grew this by 5% last year. But now that they're diluting shareholders, things could be different for the company. HP has a GF value of $30 per share, which is down 22% from today's stock price. Their cash flows seem to support just a 2% upside and a $37 fair value. Meanwhile, analysts are targeting a small downside and a fair value of $36. Stock number 3 in Einhorn's portfolio is Brighthouse Financial. This makes up 6.3% of his portfolio, and he's one of 2 super investors invested in the stock. Brighthouse is a $2.7 billion life insurance and annuity company that's trading $11 below its 52-week high and just $5 above its 52-week low. The company went public in 2017, and since then, it's down 36% from its all-time high. However, from its pandemic lows, it's up 180%. The company's recent numbers look sporadic, though they do have a net cash position on their balance sheet. There seems to be a reason that Einhorn likes the stock in that it's aggressively repurchasing shares. They've lowered their share count from 120 million shares outstanding in 2017 down to 63 million shares outstanding at the beginning of 2024. Compared to all of their historical valuations, the company seems to look cheap. The 6 analysts covering the stock are much more muted, with a $46 stock target price and just a 2% upside. CONSOL Energy is the second biggest stock in Einhorn's portfolio, and he has 8% of his 13F holdings in the company. Fellow super investor Monish Pabrai cloned this position from Einhorn and also has 8% of his US listed assets invested in CONSOL. CONSOL is a $3 billion thermal coal producer that's down $7 from its 52-week high and up nearly $30 from its 52-week low. The company nearly went bankrupt in 2020, and since then it's up more than 30 times. In the last couple of years, thermal coal pricing has gone through the roof. CONSOL has earned very high returns on capital, and they generate a ton of free cash flow. The thesis behind this company, as explained by Pabrai, is simple. They're earning these high returns, and they're aggressively repurchasing shares at mid-single-digit multiples.
David Einhorn's CONSOL Energy bet looks like Monish's IPSCO bet. And IPSCO was a company I had invested in almost 20 years ago, 2004. And I have very fond memories of IPSCO. And CONSOL was very similar in the sense that they forward sell a year in advance all the coal they're going to produce with price bands that are fixed. In 2023, they've already done all these deals where that money is going to show up in 24. And so I said, okay, this is actually better than IPSCO because you know a year in advance and you can't really lose money. The second thing that they had going with IPSCO didn't have, they were going to spend all their money buying back shares. So if you're trading at 3 times, 4 times, 5 times cash flows, and someone's going to buy back all the shares.
In that clip, Pabrai talked about the capital allocation from CONSOL. Its managers have chosen to buy back nearly 15% of their shares in the last year alone. With partly contracted revenues and cheap multiples, this can generate a ton of value for shareholders.
I would love for the CONSOL price to stay extremely low for a very long period of time. In fact, it's not good if it goes up. They would buy shares back at high prices. In general, if you have identified a business which is undervalued and no one agrees with you and it remains undervalued, at the end of the day, that business is producing cash flows. And you have a claim on those cash flows. And if the business is prudent about how it's, either using or distributing those cash flows have to show up as dividends or value to the investor. So
the company doesn't seem cheap compared to its assets, but compared to its earnings and its abilities to produce free cash flows, these are trading below historical valuations. A GF value for the company is mixed, with it coming in at $83 per share. This is up significantly from where it was at back in 2020 or 2021, but it's down from their current stock price. The cash flow numbers may support a huge 121% upside and a $237 fair value, but keep in mind these aren't accounting for the cyclical nature of the thermal coal business, and this is by far no guarantee. Now, the top stock in David Einhorn's portfolio is Green Brick Partners. Einhorn's the biggest shareholder in this company, and it makes up a whopping 29% of his portfolio. Einhorn's owned the stock for a long time, buying it originally in the fourth quarter of 2014, back when it traded for just $8 a share. He then added to it and let it sit for much of this time. In the last few years, however, he's reduced his position by a lot, and at one point it made up 44% of his holdings. Today, those original shares are up more than 7 times, and this has been a home run investment for Einhorn in the past decade. Greenbrick's a $3.5 billion Texas-based leading home builder. The company is trading just $6 below its 52-week high, and they're up double from their 52-week low. Their stock chart reflects a pretty crazy history for the company, but in the past decade, they performed extremely well. In this time alone, the company's stock is up more than 16 times. Their numbers have gone through the roof as the price of housing has increased in the United States. In recent years, they've had growing sales and a lot of free cash flow and have had growing earnings as well. The company repurchased 9% of its shares back in 2022, and they repurchased some shares in 2023 also. Altogether, home building could be a cyclical industry even if there's a systemic undersupply like there has been in the United States since the global financial crisis. Green Brick's GF value only comes in at $48 per share, which is down $28 from their current stock price. Einhorn's had activity in his top stocks, with his biggest buy being HP last quarter and his biggest trims coming from KINDR and Tenant healthcare. Now, these are the top stocks in David Einhorn's portfolio at Greenlight Capital. Which of them is most interesting to you? Let me know in the comments below.